So guys, for module 5 now we'll be talking about technical analysis basis. So this is what we'll be talking about, right? So all the objective here is to basically learn how to read and interpret the chart. So we have types of charts. So we have the line chart, we have the bar chart, and we have the candlestick chart. So these are the basic charts we have. So the line chart connect the closing price over time with a simple line. It's good for identifying overall trend. So for example, if the market is going up, with a line chart it's clearer to see the market structure, or if it's coming down. So that is that for a line chart. And we have the bar chart, which shows the open, high, low and close of each period using a vertical line. And we also have the candlestick chart. It displays the same information as the bar chart, but more visually. Each candles show market psychology with colors, but the colors varies here. You can change it to whatever you want. So for example, this is the line chart right here. This is the line chart right here. This is how the bar chart looks like. We'll head on to the trading view and I'll show you, and this is what the candlestick chart looks like. So now let's go on to the trading view and see how the chart looks like. So for the line chart, this is how the line chart looks like. So as you can see it shows a clear direction. You can see from this point price has been pushing to the downside, right? You can see that price has been pushing to the downside from that point. So and also for the bar chart, simply looks like this. As you can see, this is how the bar chart looks like. So and also for the candlestick looks like this. I trade the candlestick and I recommend as well trading the candlestick because the psychology behind the candlestick gives us more information about what the participants are doing. So for me, the candlestick is more preferable, but I use the line chart to understand the market trend, especially when the candlestick right here is not really clear. So remember, we have the three type of charts we have the line chart, we have the bar chart, and we have the most used chart, which is the candlestick. Now let's head on to the next. Also, we'll be learning about common candlestick patterns here, and the candlestick patterns we'll be learning are the doji, the engulfing, the hammer, and the shooting stars. These are candlestick patterns that when they present themselves in specific areas or level on the price chart, it signifies a higher probability of one thing happening over the other. So for the doji, this is a diagram of how the doji looks. So for the doji, there's a lot of ways it looks, but the common doji is always this, yeah, and as well as the others, but this right here is the common doji. And for the engulfing candle, what do we want to see? We want to see a bearish candle that is fully engulfed by a bullish candle. So when we mean something is engulf is simply like there is something and the next thing that comes is super lengthier and also in height bigger than the previous. So for a bullish scenario, we want to see a bearish candle that was engulfed by a bullish candle. So if this falls in specific area in the market, it gives us a higher possibility that the buyers are involved and might likely push price higher. And for the bearish scenario of an engulfing, it shows a bullish candle, which is this, a green bullish candle, and the next candle engulfs it totally. As you can see, if this is presented in a key level, then there's a likelihood that this price will continue going down. So for the hammer, as you can see the wick right here, it shows that sellers push this price down and buyers from this point were able to push back the price up and it closed bullish. So the psychology behind this candle is showing that buyers are present right here, and if it falls in specific areas in the market, there's a high possibility that the market might rally all the way up, right? Yeah, so that is that for AMA. So we expect when it forms in specific area in the market, we'll look for longs. And also for the shooting star, as you can see the diagram here, the diagram states that if this form in specific areas, like you can see we were going up, we were going up, and we were going up, and after the form of this hammer, you can see how the direction switched totally to the opposite direction, right? So that is the power of shooting star. Support and resistance will be our next topic. So for support is a price level where buyers enter the market and rise the price, and resistance is a price level where sellers enter and make a fall. And a trend line and channel helps you identify the direction of the market and potential reversal point. So it's more like a bounce between swing point, and it also indicates trend reversal. So for example, if price breaks below this trend line or channel, it indicates that it might continue going down. Yeah, so for support levels, how you understand support level is more like a floor. So once price comes and tap on a particular price point and bounce back up, there's a likelihood that when price comes there again, it will bounce back up. So this is more like a support level. So what do market participants expect when price comes back to that point? We expect for the same thing to happen again. And for the resistance point, when price is more like a ceiling, when where price get to and reverse. So you see this point here, there's a likelihood that when price comes back there again, market participants will be looking to go short for it to continue the fall. So that is that for resistance level. So as you can see on the diagram, price came here, pushed up, came back there again, pushed up, came back there again, pushed up, came again, pushed up. So this is considered to be a strong support zone. And as you can see here, we have a resistance, and when price got there, it fell, and when price got back there again, what do we see? The same thing happening. So this is a strong resistance point. And now let's get to channels diagram. As you can see right here, this is a bearish channel. As you can see, the market is falling, right? The market is falling. So this is a bearish channel, and it indicates that sellers are more in control, pushing price down. And as you can see here, we have the bullish channel. As you can see, the market is going upward, in an upward direction. So what can you see? Buyers are more like the ones pushing price higher on this channel. And as you can see, when price broke it, what do we see? A push down. So it also indicates reversal, and this is how a trend line looks, a bullish trend line looks like, because as you can see, price is bouncing off that trend line. When price comes to that trend line, you could see a push up. When price came back there again, you could see a push up. When price came back there again. So this is more like the price point that buyers are willing to engage in the market. And as you can see as well, again, you can see a bearish trend line. As you can see, price tapped here, dropped. On this line again, it tapped and it dropped, went back similarly and tapped there again. As you can see, it dropped. So these are the point sellers are engaging in the market, and as you can see, the market is dropping down. So now we'll get to the sixth model.